Best Buy just released Q4 earnings, and the market was not really happy about it as the share price did decline on the release of their earnings. And so let's cover that in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now let's get right into this whole Best Buy issue that's transpiring at the moment. And so you can see Best Buy shares actually closed 2% under where they were trading the previous day. Now this is not like a crazy issue or anything like that. Company shares always move on the release of earnings anyways, but I found it very interesting because I thought the guidance wasn't that bad for 2023. In fact, I thought the guidance was a lot better than what I was expecting them to guide towards for 2023. And so I thought that the share price would actually surge a little bit. However, it actually declined. And so let's take a look at exactly what happened. So it was of no surprise that, revenue came in where it did. I mean, it did decline across the board in all three of their segments. And of course, their operating income as a percentage of revenue also did decline. So did their EPS. You can see that, their even their GAAP EPS was $6.29 compared to almost $10 in the last year. But this was all stuff that we were expecting. And so none of this was a surprise. And in fact, the fact that they did this well in 2023, I guess, their fiscal 2023 was, largely like a good news story. But where I found that I think they outperformed was largely in their guidance that they provided. So here's their guidance. They're saying that, as they enter fiscal year 2024, the electronics industry is feeling the effects of the macro environment. And I think that this is one of those industries that would probably be more levered to the macro environment declining because, a lot of the purchases made from Best Buy are not necessary purchases, I would say. But here's the interesting thing. When they're forecasting revenues, they're just forecasting a 4% decline from fiscal year 2023. When I had originally built out the model, I'm pretty sure I was forecasting a 10% decline. And so the fact that they're only forecasting a 4% decline versus like what I was thinking of like a 10% decline is kind of crazy. Now, what this could mean is that you might have a revision in fiscal year 2023. We'll see how this plays out, where they might revise revenue growth lower. But, it's so far looking good. Now, here's the thing that really stood out to me. Their margins did go down in fiscal year 2023, but look, they expect to expand, not reduce, but expand their gross profit rates by approximately 40 to 70 basis points versus the past year as they evolve their membership program. So that's good news in my eyes. So, once again, I don't understand why the market declined, but it didn't decline that much. So I think the market's kind of neutral on this. I think they expected this, which means that the market is just smarter than me on this case. And then of course with non-GAAP EPS, they're forecasting, around $6 per share. Now I forecast on GAAP earnings, and so I'm actually forecasting GAAP earnings to come in around $5.80 a share, which reflects an 8.3% decline over prior year. And so once again, this is a huge outperformance compared to what I was thinking that they would give as guidance for this year. And so, overall, this is a very good news story as far as I'm concerned. And I know a lot of you guys would say that you probably wouldn't invest in Best Buy, and I'm totally agree with that because, this is a tough business. Retail overall is tough. You can see that sales and operating profits really haven't gone anywhere in the past decade. So this is 2012 to 2023 or fiscal year 2023. And so, they really haven't gone anywhere, but you can say that it's kind of predictable. It'll probably fluctuate anywhere between like the $1.5 to $3 billion operating profit level. So like if you buy it at the right price, it might not necessarily be a bad addition to your portfolio. Of course, you'd size it appropriately, but I could see why a lot of people would not want this name in their portfolio. I totally get it. I don't actually have them in my portfolio at the moment either. And as much as I like the company, and in fact, I bought a lot of the equipment for this channel from Best Buy, I'm not really giving them a lot of growth. I'm giving them a token amount of growth going out. So you can see that in fiscal year 2025, I'm giving them 0% growth. Obviously, I'm forecasting to what they've provided us for guidance for fiscal year 2024. So that's your minus 4% growth. But then, I'm only growing them by 2.5% thereafter. I just think the electronics industry is hard. And as Amazon continues to build out their delivery, the same day delivery type stuff, it makes Best Buy less competitive. Right now, I still think Best Buy is very competitive compared to Amazon, but I don't know. I think Amazon is continuing to take pieces, like more and more pieces of that market. My understanding of this business is evolving as the industry is evolving as well. And so, if I want something the same day, like right away, I think Best Buy is the best place to get it. However, if I can wait like a day or two, I'd probably just order on Amazon. So it just depends on the type of consumer that you are. But really what that says is that, that consumer that can wait a day or two, Amazon's going to eat that person. And so, I think that the industry gets tougher for them from here on out, but we'll see how this plays out. Also, I want to know what you guys think. Am I thinking about this correctly, or is there another way that I should be thinking about the consumer electronics retail industry? And just an FYI, guys, you guys can get access to that model and all of my other models at that lower tier of the Patreon. And so, I think it's the best value on YouTube, so please consider supporting us. And so moving on, you can see that in terms of the valuation, I'm using a terminal multiple of 15 times earnings. Based on their current share price, I'm valuing them at approximately $100 per share, so they're reflecting around 80% of their intrinsic value, and that they're trading at 14 times their expected EPS, so that's a 7.2% equity yield. So this is not expensive by any means, but what I would say is that because I'm becoming more selective on what opportunities I'd include in my portfolio, I wouldn't mind entering a position with a cost basis under $60 per share, which would reflect 12.5% equity yield on an average EPS of $7 per share, which I do expect them to get to in the next couple of years. And so we'll see how this plays out. I'll continue watching it. It's in the tracker. It might not be anything that I ever buy. However, if the share price does come low enough, it might become more and more exciting. So we'll see how this plays out. Also, I want to know what you guys think about Best Buy. Is this something that you guys want to be adding into your portfolio, or do you have it in your portfolio? And guys, just recently I put out a video on how officials in China are scrambling to fix their falling birth rate. And so if you haven't seen that video, I think it's very important, especially if you're an investor in Chinese securities. You can get access to that video right here.